If you've ever wanted to learn how to write over $5 million a year in annuity volume, Level Up Advisors Academy was built for you. In this academy, we talk about things like how to do massive annuity production, assets under management, big whole life and IUL cases. Look, 5 years ago, before I built this product, I didn't even know how to spell the word annuity, but a simple system that I learned allowed me to write over $5 million a year in annuity production and now over $10 million a year. I took what I know, the system that I've built, and I put it into Level Up Advisors Academy for you to be able to have access to it 24/7 on demand. If you've ever wanted to take your business to the next level, this academy was built for you. Click the link below to get access today. Look forward to working with you in the future. Hey everybody, welcome back to another episode of The Agent's Edge. My name is Ryan Polimeni. Today we're going to talk about Annuities 101 and the basics. Now, again, for a lot of you that know me, or maybe you've seen some of my stories, or maybe you've seen some of my interviews, you know that I do a lot with annuities, assets under management, big IULs, big whole life cases. Today what I want to do is focus on how to simplify the annuity process because, again, I think it's an important variable that you should be offering in your financial firm, depending on if it's the right thing for the client. Now, again, remember, no matter what you do in your firm, it has to be client-focused, meaning you always have to be doing what's in the best interest for the client. If an annuity is not the right thing or not the best thing, do not put them into one. Okay. Today is just basic information on how they work and how I tend to simplify the process for people that allow my clients to really understand it, understand how it fits in their portfolio, and why they would need one. So let's talk about the different types of annuities. Now, you've heard a lot about these things, and I want to make sure that we understand each type so you know where it fits. Number one is what a lot of you, if you're not securities licensed, you're not going to be able to offer it for the most part, is what's called a variable annuity. Now, a variable annuity does what it says it's going to do. It's going to vary based on how the stock market performs. So it's essentially an annuity with market inside of it. So if it goes up, down, the value of the annuity contract can go up and down as well. One of the things that will stay the same, however, or continuously keep going up, is the lifetime income rider that's attached to it, if there is one attached to it. And I'll talk about the lifetime income in a minute. So the variable annuities play a role in your client's portfolio if they're looking for something that has an income base to it, but also has a very high upside potential. But there's a cost to that. There is the cost that they could lose money, and these typically have a loaded fee structure in them. So again, if you have just a life insurance, life and health license, you're not going to be able to offer that type of annuity contract. And you have to find out if it's the right thing for your client as well. Now, the second type of annuity, a lot of you hear, is what's called a fixed annuity or a fixed indexed annuity. The difference between those two is you have a fixed crediting amount versus the index part could go up and down based upon how the market performs. The difference is in a fixed index annuity or in an index annuity, you're not going to lose any money. Your client will not lose a dime of your money if it goes down. So think about that for a second. Their client puts in $100,000, the market goes down -20. If they're in a fixed annuity or index annuity, they're not going to lose any money because it's not stock market based. However, the internal crediting is based off of whatever they offer. It could be the S&P 500 index, could be PIMCO, Bloomberg, Janus, whatever annuity company you're working with, whatever they have that you can offer your clients. Or the third type you could offer is what's called a single premium immediate annuity, or you just simplify it to an immediate annuity. Essentially what that is a product where your clients are going to put money in with the expectation of receiving an income right away. And that's got its role. So again, let's just take the three that we just talked about and figure out if you have a client that is looking for safety, that is looking for income for the rest of their life, what type of annuity would work for them? Would it be the SPIA? Probably not, unless they need the income right away. We didn't say they need it right away. They said they need it at some point. Would it be the variable? Probably not, because if they're looking for safety, they don't want to have the opportunity to lose any money. So maybe the index or the fixed index annuity is going to be your best option. Again, this is how you start figuring out where your client goes and what's best for them. Now, let's talk about some of the ins and outs of it. And I want you to really take this with a grain of salt because I know that there are a million different types of annuity products. Some are built for a few things. Some are built for short-term growth, meaning you're putting it in, you're going to let it sit in there for 1 to 5 years, and then you're either going to turn income on or you're going to start receiving some sort of annuitization or take lump sums out of it. Some are built for a little bit more of a long-term growth, maybe 5 to 10 years. That could be on a 10-year surrender schedule where they can take 10% out every single year without any penalties. Maybe they have the 10 years, so let it sit in there and keep growing, but they don't want to have a longer than a 10-year surrender period where they're going to be penalized for taking money out. Then you have a long-term annuity, which is something that's going to be anywhere between 10 to 15-year surrender period. Sometimes it's a 16-year surrender period. And you want to focus on that surrender period because that surrender period is the period of time that your clients cannot take more than 5, 10, or 20% out without paying a penalty for doing so. So it has to fit their portfolio properly or their time frame in retirement properly. I got to tell you, after doing this for 12 years and having clients come to our office that have purchased an annuity from somebody, and I sit down and I'm dissecting the annuity that they purchased, and I'm going, tell me the strategy here. And they go, I don't know. Or they go, I wanted to protect my money. Got it. Okay. But why are you in this? You're retiring in the next 5 years, right? Why do you have a 14-year surrender period? That means that if you want to dip into it, you're going to be penalized for the next 14 years. You're retiring in 5. Why didn't they do a shorter surrender period? I don't know. I don't even know what that is. You see what I'm saying? Like, you have to be insanely clear with your clients as to what type of annuity they have, the ins and outs of it, and why it works for them. Because again, it may not, but if it does, they need to know why. So here's what I like to explain to people when it comes to annuities. I like to tell people that an annuity is really built for 3 things. It is built for, number 1, preservation of principal. What does that mean? That means you give me $100,000, the market burns to the ground the next day, you're not going to lose a dime of your money. The guarantee is there because index annuities and SPIAs are mostly backed by life insurance companies. Now, there's a few investment companies that do them as well, but for the majority of them are backed by life insurance. So it allows that safety factor of the guarantees. Now, if you are doing it for preservation of principal, that's fine. People like safety, they like growth. What you want to try to avoid doing is if you are going to put your client into a product and they don't need the income, you want to make sure that you're not putting them into an income-based product. Why? Because the caps, spreads, and participation rates are usually not as high than on some of the growth products that they offer. So you have to pay attention to the product. And again, I can't get into product today because every one of you represent a different company. But this is where you doing your homework plays a really big role in understanding your products. And I'm going to tell you this straight up. If you have one product to offer your clients, you are not working in your client's best interest. I'm sorry. I don't care what company you work for. If you're coming here and you're watching this and you only have one annuity company to offer your clients, you could set yourself up for a lot of trouble, to be honest with you, because if they ever question, if the financial industry or the state ever questioned why you made that decision, you can't honestly say, well, I looked at all these different options and this was the best one, because you only offer one. So I want you to think about this analogy for a second, and this is me helping you build your practice to a bigger level and a higher level. Because if you are a carpenter and you're going to get ready to build a home, and you show up to that house with a screwdriver, and that's it, how far do you think you're going to get, and how successful do you think you're going to be at building that house? Right? It's the same thing as you being in the financial industry. You have to have a toolbox full of products to be able to offer your client, because all annuities are not a one-size-fits-all product. I write 5 to 6 different annuity companies every single month, depending on what my client is looking for. And I can't do that and do the right thing for them if I have one, okay? So think about that for a second as you build your practice. Are you limiting yourself? Because when I first started in the industry, I limited myself. I had one or two different companies. That was really all I was offering. And I started looking at this going, well, they need something, but I don't think this is the right thing for them, and I don't have anything else. So you have to add more tools to your toolbox as you grow your agency, especially if you're getting into the advanced markets world. Now, again, an annuity does three things very well. Number one, preservation of principal, and it could be for long-term growth. However, if it's not for long-term growth and using it for an income, the second thing that they're really built for is providing your client an income for life. And that's where the lifetime income benefit rider comes into play. Now, not every product has the rider built into it. Some you have to add. Some are already built to be an income product. Okay? So you have to understand your products and know what's out there. Am I putting my client in an income product, or are they just going to be able to pull money out as needed? The problem with that is they will run out of money at some point. The lifetime income benefit rider is a rider that gets attached to your annuity contract that says, you give me $100,000, I'm going to give you $500 a month for the rest of your life. It's a contractual agreement that your client can never outlive. And again, those numbers aren't exact. I'm just making an example here. But run an illustration and you'll be able to see, based upon how much your client puts in, how long they have to wait, is the income that they're going to get. Now, let's stop and talk about income for a minute here. As you develop a successful retirement plan for somebody, you should be looking at several different things. Number one, you should be looking at what are their monthly expenses while working and in retirement years. Is there a difference? Maybe they're going to have their mortgage paid off. Maybe they'll have debt reduced. Whatever the situation is, you need to know that. Why? Because if you're going to put somebody into an annuity and you're claiming that it's for income purposes, do they have an income gap problem? If they don't, what's the purpose of it? See what I'm saying? So when I'm doing my fact-finding process, I'm looking for income. What income sources do you have? Social Security. Okay, we know most people are going to have that. Unfortunately, Social Security is what most people rely on as their biggest part of their income in retirement. Maybe they have a pension. Only 16% of Americans, as of a couple years ago, have a pension. That's it. It's a very small number of people that have a pension. Maybe they have now their 401ks, IRAs, and they have to figure out a way to not outlive those. So the question you should be asking people is, what is your strategy to not outlive your money? You have $200,000 in this 401k. You're going to retire at 62. If you live to 92, how are you going to take $200,000 and stretch it over 30 years and never run out of it? What would it look like if you did run out of it at 75? Would you be able to survive? Would your income meet your expenses? See, these are very simple questions that you should be asking, and these questions allow you to choose where your client should go, what product would fit them best. So let's say that we find out, wow, you've got $1,000 a month income gap. This is where your opportunity to use the annuity with the lifetime income rider could really come into play, because you can take a lump sum of money and make that exchange for the income for life. Now, again, depending on how long you let it sit in there for, the money is going to continuously keep growing. Most annuity companies that have the income product are going to give you a guaranteed what's called a roll-up rate. And the roll-up rate is a guaranteed interest that they're going to put on the income account value and allow it to keep growing and growing until you turn the income on. Now, the longer you wait, the more that income account value is going to keep growing. Now you go income account value. What's the difference between the income account value and the money that I put in? It's a good question. And a lot of producers mess this up. This is, again, simplifying the process, because your client's going to ask you that question, and if you can't simplify the answer, they're not going to buy from you. So I want you to think about this for a second. I want you to take a piece of paper and draw a line down the middle of it. On the left side of the piece of paper is what's called the accumulated value or the contract value. That's the value that your client gave you. So in the example, your client gives you $100,000 to purchase an annuity. Okay, so on the left side of our paper, we're going to write $100,000. Now, how is that going to grow? Well, that's going to grow based on the internal index. right? So if you have the S&P 500 index, and let's just say the cap is 2%, and this grows, it hits the cap. Okay, well, that 100 grand is going to grow that year by 2%. But you said, wait a minute, what's the income account value then? On the right side of your sheet of paper, I want you to draw or write the words income account value. The income account value is the value where the lifetime income benefit is going to derive from. So a lot of the times, that's where the guaranteed interest rate is going to go to, or that roll-up rate is going to go to. Here's an example. Let's say you put in 100 grand, and so you got 100 grand in both categories, on the left and on the right. But this income account value, let's say it gets a 4% guaranteed roll-up. That means that no matter what happens to the market, even if the left side of your sheet of paper gets 0% interest for the year because the market was down, your income account value is guaranteed to grow by 4% every single year, as an example. So that's why these products can be so important to somebody who really needs income, because no matter what happens to the market, their account's going to grow and grow and grow. The longer they wait, the higher that account value grows to. The higher that account value grows when they turn on income, the bigger amount they're going to get on a monthly basis. And your job should be to know your products, to also know how to illustrate that and very simply break it down. Look, if you haven't had a chance yet to get access to my Level Up Advisors Academy, I spend a lot of time talking about this and how to actually read an illustration, how to break down the illustration, flip it over, explain it to a client so it is so simple that anybody can understand it. This is how I've been able to do over $10 million a year in just annuity production, not even including assets under management, whole life, IULs, because of the simplicity that we bring to our clientele and explain it to them, and to the point to where they go, yeah, that makes a lot of sense. I could see I have an income gap. This is going to solve my problem. Let's do it. Find the problem and give your client the solution. Okay? The third thing that an annuity does very well is it passes assets to beneficiaries, and it passes through probate. Why? Because like an insurance contract, your annuity contract has a beneficiary form attached to it. So you want to make sure that it's always up to date, because if your client dies, whatever's left in that pot of money has the potential to go to the surviving spouse, to the kids, to the estate, wherever it's going to. Okay, so let's recap the three things that an annuity does really, really well. Number one, it preserves your client's principal and allows it to grow long term if that's the strategy. Number two, it provides your client a lifetime income benefit that they can never outlive, even when the policy is drained down to zero. Usually it's 20 to 22 years before the policy is completely drained to zero. That's fine. Even when they hit that day, they're going to continuously keep getting that income for the rest of their life. The third thing that it does very well is it passes assets. You can even call it estate planning. Passes assets to their estate, to the spouse, to the kids, whoever's going to inherit that money. No questions asked. Passes through probate because they're the beneficiary. I hope this has been helpful for you. We got a lot more we're going to talk about annuities in the future here. But if you like this video, make sure you comment. If you like this video, make sure you comment, subscribe, hit the like button. Look forward to seeing you on the next episode.